All right, this is the stock valuation for international paper. It is March 4, 2022. First things first, I wanted to take a real close look at their 50/50 partnership with ILIM, which is a Russian paper company. Because of course, it's possible that exports from Russia to a lot of the rest of the world can be cut off pretty quick here. I think, as far as I know, I think things are still getting things are still getting shipped out, but that can definitely change. Um, what you're looking at right now is just a map of all the countries that the Russian company ships to, and the products that they ship. And so you see here in Europe, there's a lot of materials, specifically boxes, right? Most of the world, though, is getting pretty much paper and pulp. Pulp, interestingly enough, is what is used in diapers, and so they are a huge supplier of pulp for the world, and really a lot for China. So again, if they're cut off in Europe, if they're cut off in America, that can definitely cause some problems. I don't expect that to be the case for South America, Africa, Asia, and China, though. So this was 2005, actually before they started their joint venture with International Paper, basically just exclaiming that they exported to China the most pulp out of any company in the world. And so again, that's comforting to know that even if restrictions are put in place with things getting shipped out of Russia, they'll still have the Chinese market that they can make money with, and of course, inside of Russia as well, they sell a lot of products. I did see, again, just trying to find as much information as I could. I came across an article from 2014, which is when all of the trouble between Ukraine and Russia really started. And what happened, of course, is when there's a rumor of war, or when war happens, it can really damage an economy and damage a country's currency. And so that is right now the biggest issue, outside of just the revenue loss, right? Is that we know that the Russian currency, the ruble, has dropped dramatically. And we know the international paper has quite a bit of ruble on its books. And so what that means is that the dollar that they had in ruble is now no longer worth a dollar. And so we see from this article in 2014 from Wall Street Journal, international paper took a $1.4 billion. Well, I'm sorry, no, that's not. Where is it at? The ruble fell 10%, and uh, where is it at? Is that it? Well, a big write down. I thought it had the actual. Okay, well, all right. It didn't. It didn't. It doesn't have the actual. Yeah, here it is. All right, 31 million. $31 million loss. Okay, from this particular drop in the ruble. Now, the interesting thing about this is that the the loss isn't in cash really, right? Because all of the rubles that they earn that they own stay in Russia. They don't typically bring those rubles back to the United States and exchange them. So as long as those rubles stay rubles, then they don't really lose any money. But they will for sure have to account for that loss on their books, right? So meaning when they report their earnings next quarter, there's a very good chance that we're going to see them miss their earnings numbers because of this drop. So that's definitely something to look into. And like I said, there's also a possibility that if there are restrictions on trade with Russia, we're going to see a drop um, in revenue as well. All right, first things first, I wanted to take a look at just how well we did as far as the prediction from the last valuation that we did on this company. So what you're looking at on the right side and highlighted in yellow is the predicted number, okay, for the year ending 2021. You can go back to that video and see how I came up with these predictions. And then what you're seeing on the left are the actual numbers. Okay, so first things first. Well, I guess you kind of need to see what the numbers represent, huh? Let's do this instead. Make things a little easier. Oh, better. All right. It's not gonna quite match up like I wanted it to. If I get rid of this message. There we go. That's better. All right. So, predicted 1295. No, I'm sorry. Predicted 3621. So predictions on the left, the real numbers on the right. So predicted 3621. And remember, this was restricted cash of about $1,500. And so that restricted cash has gone away. And so the actual real number came down to about 1,300. Accounts receivables predicted 28 actually rose to 32. So that's not a horrible thing, right? When receivables increase like that, it typically means either the company is having a hard time getting customers to pay, or it means that they have more customers paying. So not horrible. Inventory was predicted at 2,100. The actual number was 18. So that's really good. We want to see inventories come down because the lower inventories means higher profit, basically, because this stuff was made earlier and they're selling old stuff, right? All right. Other assets is about the same, so we did well there. Gotta be careful not to click. All right. So we did well there. Property. This one is definitely a big thing here. So we predicted that property was actually going to come down, okay, which it did, but the property value came down a lot more than what I expected. And so I think I said this before in previous videos that this company is a declining balance sheet, meaning that it's losing value over time. Now, some of that has to do with the fact that the company is getting rid of, pieces of itself and really scaling down to be a more focused, lean company, which is not a horrible thing, but just looking at the numbers, when you see a declining balance sheet, that's not always great. Another really interesting thing, and I'll talk about this here in a moment. I did it again. Is the trees, the forest land. It's predicted at 261, and the actual number was 18. But this number here was based on, or the 261 was based on previous reports, right? And since then, the company has gone back and revised and amended those reports. So it is what it is. Investments stayed about the same. That hasn't changed. The pension, which is something that I think I talked about quite a bit in the last video. We predicted 500 is actually 595, so that's really good. Their right to use assets I'm going to have to bring this down. Right to use assets are 405. The actual number, however, all right, actual number, where we at use? Okay, the actual number, 365. So very close. And then of course the total, we predicted 25, 849, and what we got was 22. You know, that's tough. Again, it means that the balance sheet is declining faster than what we expected. Okay, payroll predicted 426, actually came in at 440. That's not great. And then we have total debt. Now this is where the cash went. Okay, and again, this is not a bad thing, right? So we predicted the debt would be at 13,275. The debt actually came in at 11,186. So that's great. They got rid of debt with their cash. So that's kind of what we want them to do, because that means that interest expense is going to come down and profit will come up, right? Okay, so taxes, we predicted 28. It actually came in at 26. I think that has a lot to do with their revision and amendment, okay? Their pension liability, we predicted 650, actually came in at 582. So again, really great, right? We want to see that pension liability come down for sure. Their lease 300 is what we predicted, came in at 236. So these are all liabilities. So the lower these numbers are, the better, okay? And then we see other liabilities. We predicted 2348, actually came in at 1099. So again, that's really good that they're getting rid of a lot of those liabilities and debts and things that they owe. Again, the less of that you have, the more profit you have. And so that's always what you want to do, is owe people less and make more, right? And so total liabilities, we predicted 19.8, and the actual number was 16,161. So really great, okay? So I think where they lost on the asset side, they made up for it on the liability side, okay? So problem is, though, the net predicted was 6,032, actual 5,952. So not very far off at all. And so let's see. Oh yeah. Come down now. Let's take a look at the income. Right. All right. So as far as revenue goes, we predicted that they were going to bring in 19, and they actually beat that, bringing in 20. So again, really great. Cost of goods sold came in at 13,005. 13,832 is what it wound up at. And really, cost of goods sold is not a big deal. What's really important here, though, is this number, the 68%. That is gross margin. And what that means is that 68% of their revenue was cost of goods sold, meaning that if you buy something for 50 cents, you're able to sell it for $1. In this case, they bought something for 70 cents and sold it for $1. Okay, and so we predicted correctly that the gross margin would be 68%, and that's exactly where it was. Meaning, it doesn't really matter what the cost of goods sold are, because it's always going to be roughly 68 to 70% of their revenue. Okay. What we want to see, though, is we want to see that number come down. We want that gross margin to be something like 50%, if at all possible. Okay, payroll. We predicted 1417. It came in at 1385. So what that means is that it's about the same, but remember their payroll liability was a bit higher, and so that just means that they owe employees that they haven't paid yet. basically. Okay, distribution expense 1543 actually came in at 1444, so that's really good. It just means that they're figuring out ways to pay less for things. Taxes, we predicted that they would pay 500 in taxes. They actually only paid 327. Again, I think that has a lot to do with their revision and amendment. We'll talk about that in a second. Other expenses, we predicted 250. They actually ended up paying 500. So not quite sure what that was from or why that happened, but it is what it is. And then I talked about this in the previous video. Really thought that the investment income would be a lot higher. Matter of fact, let me double check here just to make sure that we are, let's see, investment. Yeah. All right. So, yeah, really thought that the investment would be a lot higher. And I think that's going to play a part in how we evaluate this company going forward, because we predicted a $500 gain when in fact they only got about 179, 200. Interest expense 398 is what we predicted. Again, because they paid off a lot of their debt, the interest expense was actually lower at 337. So good. We definitely want to see that come down. And then the pension, we predicted that they were not going to receive any real benefit or cash benefit from their pension, but they did. Okay, so that was actually pretty big that they got 200 back on that. And let's see, okay, and then the net. Okay, and then so we predicted a net profit of 25. They actually got 28. So the company did better than expected. But again, a couple of things that I would definitely keep in mind when going through this thing again is that investment income and definitely the pension, I think, is something to look at. Also, too. Again, declining balance sheet, declining a lot faster than what I expected it to decline. So again, something that definitely have to take a look at. So let's quickly get into this. Now, this is going to be just a tad bit different because I already had the numbers from 2018, so I just kept them in there. If I do this again, meaning another year from now, I'll definitely take the 2018 numbers out because I don't want to have too much of a backstory when I'm looking at these numbers. I want to try to keep everything kind of right now, and I've always said that 3 years is about where you want that to be. So again, what you see and highlighted in yellow is the predicted numbers, okay? And these numbers are predicted based on a standard deviation, statistically, meaning that there is a 70% chance that the predicted number will be either more or less than the number that you see here. So for instance, the cash in 2021, we've already talked about this, 1295 is what the cash is. The standard deviation is 389, meaning that there's a 70% chance that the 2022 cash position will either be 1295 plus 389 or 1295 minus 389, okay? And so then the question for us as analysts is, well, do we think that the cash position is going to be higher or lower, right? And so based on the fact that we know that, again, the balance sheet is declining, right, number one, we also don't know of any businesses or any segments that they are looking at potentially selling, right? So, where would all this extra cash come from if in fact the cash balance is going to increase? I don't see that happening. They've already gotten rid of the SLVM. I don't know how to pronounce it. I think Silvo or something like that. So I don't see them divesting anything more. Maybe again they pay off some debt, and so interest goes down. So maybe they keep a little bit of cash on hand, but again, I expect this number to come down. Okay, so receivables, I just said that the receivables increased from our last prediction. But again, My concern is the um, the Russian thing and how much that's going to impact the company. We do need to talk about this because I think this is going to make a difference here. So revenue 22,937, and we know always sirens. Okay, and we know that the Russian company in 2021 paid out 311 million. Okay, and so we're talking about 300 divided by 22.5, we'll call it, is roughly only. Let me make sure I'm doing that right. Okay, so 300,000 divided by 22.5. Okay, so 311 million in revenue is what the Russian company brings in, right? And so, question is, what percentage of that is total revenue? And so we know revenue in 2021 was 2308. So let's do the math. 2308 times 1,000. Okay. That's 10,000. 2308 times 10,000. There we go. 203 million. Let's make sure. So what I'm doing, just so you know, is they don't write out all of the zeros for the money. So you have to divide by. There we go. Millions. Okay. See, man, sometimes the financial records are in thousands, sometimes they're in 10,000s. This one's in millions. Okay, so what that means is that I have to take the actual revenue, the 2308, and multiply it times 1 million. Okay. All right. So that gives us 20 billion. All right. That's what I thought. Okay. Now, the question is 311 million. What percentage is that of, there we go, of the 20 billion? 20 billion 300, right? Somewhere around there. There we go. Ooh, finally. Okay. Well, so I had this right the first time. So it's only like 1%. So it's not a huge number. Okay. So even if we completely got rid of the earnings from the Russian company, I don't think it's going to matter a whole lot. And so, with that being said, receivables, I think, can either stay the same or increase. Okay, especially because we talk about the company saying that things are going to get better, right? They're saying 2023 is when this is going to happen, but let's be conservative and say that receivables are going to stay the same. Okay, we're not going to see a decrease. but we're not going to see an increase either. Okay. All right. Inventory, increase or decrease. I think it'll stay about the same. If it does come down, again, that'll be really good. It can be conservative. We'll keep it the same. All right. Other assets. These other assets, again, I don't expect anything to really change from that. If they divest something, then the other assets will come down. We can see that over the history, it's been really choppy. So from 2018 to 2019, it came down a little bit, and then it increased by a lot in 2020. And then came down again 2021. So I think they're going to stay about the same. Again, if they do divest, that's great. We'll see that number come down, and we'll see cash go up. All right. Property. This is the one that, again, has been declining faster than I expected. Now, we have the option of using a 2 standard deviation, which puts us in a 90 percentile prediction rate for this number, but I think that's just way too much. So again, I do expect the property to come down, but it can come down further than what this is here. All right, and then trees, forest land. Again, 2021, 18. Okay, if you go back to 2020, 2019, we see these numbers were a lot larger. Okay, and that brings me to what I want to discuss, which is, and I talked about this in a previous video, the importance of amending the return or amending old returns, right, for a benefit. So what you're looking at right now is the 2021 annual report, okay? And these are the numbers. The revenue is at the top, okay? Now, let's take a look at the 2020 annual report. Right, same categories here. And this is also why it's really important that even if you want to pull numbers from 2018, you need to go get the most recent financial report possible. So if they have a 2021 financial report, use the 2021 financial report to get 2018 numbers. Don't go to 2018 to get 2018 numbers. The reason why is because they're always going to be revising and amending. Okay, so something as simple as revenue, how much money they made. Okay, so let's look at 2020 numbers. It's 2580, right? 2020 here, 17,565. They made less money. Why would someone want to change their financial records to show they make less money? Well, there you go. Taxes is a big one. All right. So 2019 number is 18,317. 2019 here, 22,376. Now here's what's important. 2018, 23,306. And we don't have 2018 here, but but just so you know, typically the 2018 number from the 2020 report and the 2018 number from the 2021 report will usually be the same, because by that time they've revised it and amended everything years ago, and so it won't change. Let's see. Yeah. So this is the 2019 report. Okay, and so you see the sales here at 23,306, 23,306, right? So that's what happened with this forest land, and so sometimes this can be just a different way of accounting for something, right? And again, that goes back to why I think it's so important that you do either file every 3 years or make sure you amend every 3 years, because it gives you 3 whole years to think about how it is that you want to actually report your earnings or report your expenses or what have you. And so again, it means filing the return, paying the taxes, right? Filing the return, paying the taxes, and then go back, amend the return, and then of course you get a refund plus interest. Okay, and so we see this over and over and over again with these large companies where they constantly amend and revise. And again, that's why if you want to get 2019 numbers, you really need to have a financial report from 2021. You don't want to go back to 2019 and pull that report. You want the most recent report. Okay, so again, based on the 2020 annual report and the 2021 quarterly report, the trees, the forest land was actually much higher. Okay, they've obviously gone back and decided to maybe include forest land and trees in other assets versus forest land. I don't know, but either way, the number is much lower now, and so that's why you see such a large deviation from average here, which we can't use, right? This is where statistics fails us, is when there's such a stark contrast and such a large drop off that all of a sudden you can't predict anymore. And so we're just going to assume that the trees and forest land is going to stay about the same and nothing is going to change there. Okay, so investments. We talked about this just previously. In 2021, the investments were $3,000, and again, this is balance sheet. This is what they actually own. Okay. Interestingly enough, the deviation calls for getting rid of that number completely. Okay, and just to show you kind of what we're looking at here, in 2018 the number was 8,000, 2019 8,000. Then we got a dramatic drop off of 3,000, meaning that obviously there were some investments that they completely got rid of. Where that money went, what happened to it, I'm not sure, but we do see that the other assets increased by quite a bit in that same year, from 1,000 to 9,000. So again, maybe it's an accounting change, or in this case, maybe they actually sold out of some investments. But either way, we have a choice here to either assume that they're going to stay about the same, that they're going to dramatically decrease, or they're going to dramatically increase. And so, again, dealing with a declining balance sheet historically, I sincerely don't think that these investments are going to increase at all. If anything, I think they're going to dramatically increase or stay about the same. For right now, we're going to assume that they are going to dramatically decrease to zero. Okay, and we'll go back and take a look at how that affects things in a moment. All right, so the pension, again, this is balance sheet. This is what they actually own. Okay, and so we know that the pension has been zero, and it's only in 2021 that we see a pension balance sheet item for $595. And so the question becomes, again, does that stay the same? Does it decrease? Again, dealing with the declining balance sheet, we're going to say that this decreases. Okay, to be very honest with you, I'm not sure why it would. I know that the management is very happy, very comfortable with where their pension is. Okay, and so again, we're just going to stick with a declining balance sheet to be conservative about things. All right, right of use assets. We're going to assume that this stays about the same. It has been historically, a small drop every year, 5%. And so either it's going to, continue dropping by that 10%, or it's going to stay about the same. And so we'll just keep it the same. We're definitely not going to use the statistic of 200 here, because that's way too much. All right, and then total balance sheet, again, it will decline. That is just historically, that's what has happened. So we're expecting a decline from 22 down to 17. The only thing I think that can make a huge difference here is the investment. But the problem with that is if we put the investment in at the 3,000 that it is now, that brings the balance sheet all the way up to 20,000. And there's no way that this balance sheet is not going to continue to decline. you know, it's possible to, um, you know, bring down some of these other numbers that we discussed, but um, that'll be really difficult to do and still keep a declining balance sheet. So, um, again, I expect it to decline. By how much? Not sure. Um, will it surprise us to the downside like it did before? Maybe, right? All right, so let's keep going here. These are liabilities, things that they owe. Okay, payroll 387 versus 440 in 2021. I think that's fair. Again, for sale. These are things that they're holding for sale, and they don't have any. So again, I don't think they're gonna really be divesting anything here. Okay, so debt. The debt has come down quite a bit. I think that they have purposely, when they talked about it, they're intentionally trying to reduce debt. So we see there's a decrease in about 15%, and then a huge decrease last year of 35%. So I think that's either going to continue or is going to kind of level off, right? So at this point, we'll assume that this will continue, but not at you know not at the rate that it has. But again, we'll play around with the numbers here in a moment. Okay, taxes, tax liability. I think that's going to pretty much stay the same. It has come down over the years. And again, this goes back to their revision and their amendments. So I think 2592 versus 26 is about right. All right, the pension liability. Now, the pension liability historically has been fairly large. Again, my issue with the pension is if they have, see, if you look at the pension asset here in 2021, 595, and then the pension liability 582, that means it's even, it's zero, right? And so my assumption here is that we're going to basically zero again in 2022. The question is just, how do we do that, right? So just mathematically trying to get this to zero, I think is really what it's about. And so I'm using the statistic in both cases to reduce this pension number on the balance sheet that will basically bring it not even, but at least closer to even. Okay. I can't, there's no way statistically I can bring this down further without going into the negative. All right, leases. Leases have come down year over year pretty precipitously, so we expect that to continue. Will it come down by as much as, half? I doubt it. But again, statistically, I don't have a choice. Either bring it down by half or take it up by half or leave it the same, right? And we know that it's come down by, on average, maybe about 10% a year. So I'm comfortable there. All right, so other liabilities. These have actually, just all over the place. Up 20%, down 50%, up 12%. So I'm going to keep this about the same. I don't see any reason to really mess with it. And then total liabilities, see a big drop off here, 11.8 from 16. And we do know that it has declined over the years. So again, will it decline as much as, was this maybe 30% again? Maybe, it's about a 30% drop off, declined 30% last year. I don't know. Let's take a look at the total assets here. See 20%, 3%, 20%. And so the question is, does it decline by, roughly 20% again? Yeah, I mean, it's possible. It's possible. So that gives us a net of 52, which to me kind of makes sense because 2021, the net was 59. And again, we know we're talking about a declining balance sheet. So 5216 lets me know that our numbers are probably in line with what we're going to see. And remember too, the last time we did this, we were surprised to the downside of the net balance sheet. So I think if we get this thing wrong, we're going to get it wrong being too high, right? All right, number of shares, not going to change. They haven't played around with any sort of equity financing or anything like that. Everything's been cash debt. So shares not going to change. The price, this is basically the net profit divided by the number of shares, okay? I'm sorry, the net balance sheet divided by the number of shares. Because, so the way it works is if you own $100 worth of something, but you owe someone $50, right? Then what you actually own is $50. You don't own 100, you own $50. And so what we're doing is we're taking everything that the company owns and dividing it by the number of shares, meaning that each share is backed by roughly $11.62 of things the company actually owns, okay? And as we play around with the numbers up and down, we can see that price go up and down. Historically, well, not historically, but currently, I want to make sure I'm doing this right. Yeah, currently the price is $42.01, okay? That means that the ratio of what the company owns to the stock price is about 28%, okay? Price to book, and I'm reading this as I go, is the price, okay, this is how much more the stock price is to the amount that the company actually owns. So if the price to book ratio was 1-to-1, it means that the stock price would be $11.62. Basically, no one is willing to pay anything more than what the company actually owns, and that's almost never the case. Sometimes you'll see that with banks, right? Where for the most part, what a bank owns is the stock price a lot of times. In the case of a company that's selling products and services, that's almost never the case. You'll always be paying more for the stock than what the company actually owns, because you're paying for future earnings. Okay, and the idea is that those assets that the company owns are revenue producing, which they are. So anyway, that's the price to book. Now, what I did was I broke out, and I did something a little different this time around than what I did in the last video, which is I broke out. I'm gonna see if I can reach this. Uh-oh, what happened? Here we go. All right. So what I did was I broke out not only the price, but also price to book, and I broke out the percentage of the price to book to actual stock price. It's hard for me saying that. For both the lowest stock price of the year and the highest stock price of the year. Okay, and so for 2021, the stock has gone up as high as 61.81, and it got down as low as 43.87. Okay, and so what that means is that the actual price, right, for the company, what they actually own, divided by number of shares, okay, 21% of this stock price was part of the share price, okay? And again, the lower the number means that people are willing to pay more for the stock than what the company owns, okay? And then it got down as low as 30%. Okay, there we go. Still looks weird when I do that. Okay, and it got down as low as 30% or as much as 30%. 2020, it got up to 26%, down to 50%, which is a huge drop off. Huge drop off. And then we go from 30 to 39 in 2019, which I think right now is like the slimmest margin. And then in 2018, we see a huge drop off from 35 to 63%. So historically, and I didn't do the statistics on this, but historically, as we can see, it's either been a slim margin or it's been a huge drop off. Okay, and so in 2021, this was a fairly slim margin, 21 to 30, where historically it's been a huge drop off. And so the question is where are we now, right? So right now we're at 28%, and so 28% has been really close to the top of the range, right? So see 35, 30, 26. And remember, the lower the number, the better, okay? And so right now we're at 28%. And I believe 4201 is really close to the low for the year so far, all right? And so for the low of the year so far to be at the top of the range is a bit concerning. It's a bit concerning because it means that we're either going to go down from here, right? Or we're going to have a case where the stock price moves higher and 28% is at the bottom, and maybe we see another slim margin of 19 or 20% at the rest of the year for a higher number here. Now, the question becomes, if it does, now keep in mind, historically, it's never been more than 21%. All right. So the question is that if the stock price goes to 21%, what is that price? There we go. $54.17, which, you know, um, is a lot higher than where it is now. But again, that's at the very top. It hasn't been that since, it hasn't been that in the last 4 years. So whether it gets back to that, I don't know. Tough to say. So here's what I come up with, okay? This is the lower end, right? And again, we're talking about based on the last 4 years. Okay, based on the last 4 years, it's very possible that we see the stock price get down to $25.40. What does that mean for the percentage? Let's see. We'll do price divided by there. So that means that on the low end, we see something like a 46% here, and then on the high end, maybe 28%. Maybe it gets up to 25. It's really hard for me to see it getting back to 21. And I can definitely see a 28.46 versus 21.30 here, honestly. But let's take a look now at the best case scenario, 41.37. And again, that puts us below where the stock price is now, meaning that this current stock price is overvalued. Not by a whole lot, but overvalued for sure. And now let's take a look at what that percentage is for stock price of 41, and that is 28%, exactly where we are now. I'm curious. I'm going to bring this out a couple of decimals. See what the difference is. So yeah, just slightly, um, just slightly. And so that's what we're looking at as far as the balance sheet. And again, we can play around with some of these numbers. The one thing that I think is going to be a really big difference here. And if we look at the assets to try to bring the stock price up, right? We're either looking at increasing receivables, okay, or we're looking at maybe the property stays the same. Maybe it doesn't decrease like it's been decreasing the last 4 years, right? The investments, maybe the investments stay where they are. Let's see where that puts us. All right, so that gives us a lower end of $40 and a high end of $65. Now, what does that do to our percentage? Well, it makes our percentage jump all the way up to 44%. And looking back historically, 40% is definitely at the lower end of the range, meaning that where we are currently at 4201 is going to be the lows for the year. So, and then the high moves us to 65, which is way up there. Let's see what that does for us. Price divided by 5 puts us at 28%, which again historically has been about where the high is. 2021 was the highest at 21%. So again, I can definitely believe that. I can see that happening. And at this point, just looking at our numbers here, to me, this seems like it's going to be the largest component, right? The other thing, again, we talked about the pension. Always zeroing pretty much every year. It'll be really hard to get this to zero unless, of course, we just assume that for whatever reason, the pension assets go from 595 to almost nothing, right? So if we do that, that'll get us to zero. And that gives us a low of 38.90 and a high of 63. And if we're at 42, we got quite a long ways to go to get to 38.90. Let's see what that does for us as far as percentage goes. So 46% on the low end, which is definitely doable. And then on the high end, 28 again, which is definitely doable. So I just want to go back because I said something here that I think is important. So let's go fix that. Let's take our investments back to zero. So I don't have the benefit of rewinding to listen to what I just said. So if we go back and look at these numbers here, divided by price divided by 25, that gets us to 46%, which is definitely doable on the low end. Then price divided by the high is 28% on the high end. Again, doable. So it's really hard to say, honestly, based on the book price. I am, you know, I'm willing. I mean, being that the number has always been something, right? Let's just assume that it stays about the same. Let's assume it stays about the same. Let's assume that the pension also um, stays about the same. I'm just not entirely sure. Let's see. Let's do this. Let's assume that the pension liability stays the same. And let's assume that the pension asset stays the same. And then that'll get us to 0. There we go. That'll get us to 0. All right. And the problem with that, though, and I talked about this before, the problem with that is that it means that now our balance sheet is increasing, and it's never increased, always declined. So I can't, there's just no way. There's no way this balance sheet increases. So it's just, I cannot imagine. And the only way to get this to decrease further with being something like a $1,800 difference. And where does that go, right? Do we increase our debt? Let's see what happens if we increase our debt. Okay. So if the debt stays about the same, we still have a declining balance sheet. Puts us at 2134. Now I just saw something interesting. Yeah, no. It did increase, the net did increase a little bit here in 2021. That's the net, not the actual assets. So, I mean, I can be okay with it increasing a little bit, but yeah, but my issue with that being is that it puts us now at a high of 42. That's I don't know. That's hard for me to see, you know. And then price to book is the other thing I haven't been looking at. 4.28 puts us kind of, well, puts us higher than what it's ever been. But 2021 was higher than it's ever been. I think the average is right around that 3, 2.5. You can see that it does get down to 1.5 in years that we see a big drop off, right? I can't imagine the price getting down there. Let's see, if the high is 42, let's see what happens if I there we go. Yeah. So if the price did get down to $21.47, that would put our price to book at 2, which is, you know, the low end historically, basically, for price to book. So, I mean, you know, I'm having some real difficulty here. I have 2 scenarios that give us basically an undervaluation, and one in which gives us an overvaluation. And the issue for me is that the overvaluation that we're looking at right now is, as far as I can tell, I mean, pretty very possible to happen here. You know, if we bring the debt down, which the debt has decreased historically. 15 went up by, and then 35. So the debt drops, then we have a net increase. Still a, let me see, assets. Yeah, so still a declining balance sheet because it goes from 20 to from 20 from 22, which is about a 10% drop. So I'm okay with that. That's reasonable, but it does increase the net by quite a bit. Um, and that gives us 38.40 on the low end, 62 on the high end. And just technically speaking, without really even doing technicals, I mean, we know that the price has gotten to 60 before, right? It's not unheard of. So let's keep going. Let's look now at the earnings and see what that does for us. Of course, I did look at the dividend, and the dividend has decreased over the years, and the dividend right now can be taken care of completely with cash on hand, meaning that they don't have to do anything at all. Other than just use the cash that they have to pay out the dividend, and then the profit, which is really important, is what dividends are actually paid out of, can more than take care of the dividend. So, I don't think there's any risk of that dividend being cut anytime soon. If we look historically, 4, 7, 2, 3, so it's up there. It's up there. So whether or not that's a good number, we'll see here in a moment. All right, so revenue. Assuming revenue increases, and this kind of goes back to the accounts receivable question, right? So if accounts receivable increases, then typically that means revenue will increase as well. And so historically, it's fallen sometimes by quite a bit, but 2021 was a bang up year, even though, like I said, the earnings calls are never great, and management seems incompetent at times. Revenue has grown. The other thing that I think is important to mention, I talked about this before, which is the gross margin. I have a gross margin of 64% versus 68% in 2021. Historically, it's been about that 68% number until you get here in 2019, I think this is, where it got all the way down to 55%, which is really good. Now, statistically, it's possible for this gross margin to get to 64%, though I don't, they management does talk about things getting back to normal. So if they're able to decrease their gross margin because of their efforts, that's really good. Happy about that. If they don't, then we can assume that the gross margin will stay at about the 68% range, meaning that the cost of goods sold is going to increase more than the statistical 784 that you see here. So we'll come back to visit there here in a moment. All right, so payroll, we're assuming it's going to come down, and that's something that I think I talked about in a previous video, which is whether or not their employees are happy. They did talk about having a hard time getting talent and getting employees and things of that nature. So maybe that number comes up some. We'll take a look at that in a moment. Distribution expense, I think historically it has increased year over year, except for this one outlier year. So I'm okay with that increasing by 100. Taxes. Now, the taxes, again, they've done really well as far as I can tell with bringing that number way down. Again, a lot of that will have to do with their revisions and amendments. The thing, though, is that we cannot assume that the tax amount that they've paid in the past is going to be the tax amount that they pay this year, because we know that 9 times out of 10, whatever they do pay this year is going to be revised and they'll pay less, right? So I'm okay with that number increasing. Do I think it increases by 50%? No, I don't. But statistically, I have to use the 168 number, right? So that puts us at 495, which I think is really too high, but we'll look at that here in a moment. All right, so other expenses. A lot of this is going to have to do with legal stuff and divesting and also, legal matters and whatnot. They also talked about the whole supply chain, blah, blah, blah. So I think we can see that increase. Does it increase by 50%? It has. So why not? And that's a tough one. But historically, it has definitely increased. It's increased really by more than 50%. But statistically, that's where we're at. Okay, so investment expense. In times, this negative number means that they've actually made money on their investments. But that has not been the case historically. 2021, I think, was an outlier. And I think I talked about that earlier too, right? So I'm assuming that 2022, they are going to go right back into spending money on their investments, especially when you talk about, the foreign exchange and things of that nature. So, will it get back as high as, 300? I don't know, but I'm okay with the 129, statistically speaking here, right? Okay, so interest. Interest, I actually expect to decrease just because they are, moving debt off the balance sheet. And historically, the interest expense has definitely come down. So we're going to bring that down to 254. All right, so here's another one. So the pension, again, 2021, 2020, they saw pension benefit, right? Meaning that they actually made money on their pension versus having to spend money on it. I think that is going to continue, but I don't think it's going to be as great as it has been. And so we're reducing that down to just the 80 versus the 200 that it was in 2021. So net on net, that gives us a net profit of 39.10 versus the 28.53 last year, meaning that their net profit is going to improve. I'm okay with that. We know that over the years, net profit has really moved around quite a bit, 3,000, 6,000, and then dropped off dramatically to 1,500. And then in 2021, back up to 28. So, where this number lies, who knows? But we already kind of talked about the things that we can kind of play around with here. I think payroll can possibly be a bit higher, but that's not going to move the needle. I think the biggest issue is going to be this gross margin. So let's take a look at where we are as far as price goes. Lower end, and so again, when we talk about the percentage of price, we're talking about the earnings. Okay, so earnings per share is literally their net profit divided by the number of shares. And so what we're really getting to here is that, again, the company we know is going to make money, right? And they've made a profit every year for the last 4 years. So we know they're going to make a profit. And so that means that part of the share price is made up of profit or future profit. Okay. And so currently at 39.10, that makes the earnings per share $8.71 of the stock price. Okay. If you add the earnings per share with the price to book, right, that gives you, profit plus, and then so the rest of that is basically just intrinsic value, meaning it's the amount that people are willing to pay above what the company is actually worth and what the company is actually going to make. Okay. All right. Now, with that being said, we have what's called price to earnings ratio. Okay. And this is literally just the stock price multiplied by the total number of shares divided by the net profit. Okay, and so currently, right now, well, not right now, but the statistically, the average is 8.83. And just like before, I broke these out into the high end and the low end. And so 883 puts us in the middle of really all of these, except for back here in 2019, and at the high end 2018. So, looking at 2021 and 2020, that 883 is really about where it's supposed to be. We know it can get as high as 13 or 9, but 883 is not bad. So again, that lets me know that our net profit is probably correct. Okay. All right. Next thing is, what is the earnings per share percentage of the share price? Now, the higher this number means that the less people are willing to pay above what the company makes as far as a share price goes. Okay, so 21% of the company's share price is made up of actual profit. Okay, 80% is made up of other stuff, including what the company owns. All right, so historically, let's look at that. Okay, so on the high end, because remember, the lower the number, the higher the stock price. Okay, so on the high end, 10% got down to 14% last year, 7, 14, 31, 41, and then 12 and 21. So the question, I think, for me, is really straightforward, which is, which year, right, does this 21%, which is where we are now, or where we actually, so 2021, the number is 636. Okay, so let's do this real quick. So I have this straight in my own head. We're going to take the earnings per share and divide it by the high, 10%. Okay, and we did that. Sorry. Okay, so 10%, 14%. Okay. So, the reason why I'm pausing here is because the 871 is a predicted number. It's not an actual number. It's just a predicted number. And so my thinking here is, what happens if we don't get this 871, right? What happens if it goes lower? And so that's kind of where my mind is at right now. We'll come back to that. Okay, so 21%, what year is that closest to? Well, it's not close to 2021. Definitely not close to 2020. It's more along the lines of 2019 and 2018. And what's interesting for me is that in 2019, that 20% is right in the middle of these two numbers. That's not on the low end, it's not on the high end, it's right in the middle. But for 2018, that 20% is definitely at the low end, meaning that we have higher to go. Okay, so just based on that, the question becomes, which year is this more likely to shape out as? Right? I mean, if we're currently at 21%, and again, this is a predicted number, unfortunately, but if we're currently at 21%, that puts us on the low end of where we have been the last 4 years. Period. And again, this is a predicted number, and even this predicted number shows a growth in net profit, which we know can happen, right? Because it's happened before. how much that growth that growth is, who knows? Again, we can play around with some numbers, but um, so that tells me that we're at the lower end of price performance this year. All right. Um, PE ratio, we kind of already talked about that. PE ratio is just, how expensive a share price is. And as we can see, it's really sort of in the middle, other than the 2019 year. So I think we're okay there. The PE ratio historically um, has gotten down to 5 on average. And so what we're looking at just as a price, I want to make sure I get this right. Okay, yeah. At the current net profit, okay, at the current net profit, we're looking at a low of 46.24, which is again under valuing the share price at $42. Okay, and then a high end of 76.88, which is grossly undervaluing the share price at $42. It's almost a 50% increase from here. And then the question becomes, have we ever seen IP share price move 50% within a year? And yes, we have. And then the question becomes, well, which year did that happen? Well, this is a 50% move roughly. That's a 100% move. That's 50% move, and then almost 100% move. And so again, we're talking about 46 and 76, which is a 50% move. So, I mean, it's definitely possible, but again, we're at 42. So 50% from 42 is actually 60, which puts us more in line of our book price here, okay? But if we use this number, then we have to assume that we can definitely get down to 38. And then we're talking about really more of a 50% move, almost 100. So this one is difficult. It really is. Let's see if we can bring this number down a little bit. Let's say that our cost of goods actually is more along the lines of that 68% number. And we'll assume that our revenue is going to increase. Okay, still assume that. Let's assume that our payroll is going to be higher, because I think we were shocked on our last go round for that one. The investment is going to turn into an expense. Interest is going to come down. I'm okay with that. Pension being a benefit, let's assume there's no benefit at all. And so that gives us a net profit of 27, which is a small drop from 2021. If that happens, that won't be a good thing. But let's see where that puts the share price at, though. Okay, so that gives us a low end of 32 and a high end of 53, which we're still talking about a 50% move, and it currently overvalues the share price at 42. So it really is a real quagmire. It really is. It appears that if nothing changes, right? Go back and do this again. Because I think what we're looking at here with these predicted numbers, I think this is nothing changing. Other than maybe, the tax thing, maybe the pension, you know, maybe we'll see a benefit from the pension. I don't know. And my thoughts on the pension and investment thing is in 2021 we know that we had a huge run up in the stock market, right? Um, 2022 so far that's not been the case. So you know, currently the market is down about 10%. Um, can it go higher? Of course it can. What takes it there? I'm not sure. Um, we have a long way to go. Is the trick? We have a long way to go, and this company is talking about changes not really showing fruit until 2023. So, um, yeah, I think the numbers that we're looking at here on the income statement, I think are a case of nothing really changing. Everything pretty much staying the same, and we have a high of 53 and a low of 32. All right, going back to the balance sheet, and I just want to stick with the same thing here with nothing changing, right? So, um, cash coming down because debt comes down. I'm fine with that. Um, receivables staying where they are. Again, I think conservatively, um, that's okay. But we did talk about revenue coming up, though. And if revenue comes up, then we can assume receivables will come up. So let's go ahead and let's add that there. Inventory, um, we can see that come down. The problem is statistically, we would have to bring that down to a negative. That's not going to happen. Um, or we would have to increase it threefold, which that's not going to happen either, unless for whatever reason they just go crazy with producing stuff but then not selling it. So I don't see that happening. Some of the other assets, again, I don't think they're adding too much or taking away too much. The property, it's possible that that stays the same. Again, historically, they've been getting rid of stuff. Um, the investments, again, I mean, the only way for that number to move higher is they would have to use cash to do so. And so they don't have the cash to really do anything with these investments. They haven't talked about making any sort of real investments. They've just been talking about maintenance and figuring out the supply chain issue. So I think the investments stay the same. Again, maybe some comes off, but statistically, I would have to bring everything off, and I don't think that's the case. The pension, we've already talked about that. That remains at zero for the most part, if nothing again changes. The right to use assets, keep those the same. That still gives us a declining asset side of the balance sheet, which again is historically accurate. Um, Showing payroll coming down as far as liabilities are concerned. Maybe that increases, but honestly, those liabilities with payroll are typically going to be things like overtime or maybe some sort of incentives. But the only way I see that happening is if they again have a blowout quarter or blowout year where they just do a lot in sales, meaning that revenue is going to increase more. So I don't think that's going to happen. And then the big one I think is debt. Statistically, we're looking at taking off 3,000, which is definitely possible. Whether or not that happens, I don't know. Um, Taxes about the same, lease about the same, other liabilities about the same. So yeah, I can't. The only thing that bothers me with this scenario is that it increases our net by a lot, you know? And then part of me is just like, well, that would be a good story for the company, right? I just don't know if that's possible to do. And so if now, I know I looked at this before. Let's just do this again. Oh, wait, no. If we keep the debt the same, if we assume that the debt doesn't go anywhere, but we also have to assume they do something else with cash. I don't know what. Let's just. Wait a minute. Why did that not move? All right, there we go. So let's assume, I don't know, they pay off some debt, maybe they get some more debt. All right, fine. So it stays the same. That gives us a net decrease on the balance sheet. So, which is definitely possible historically. And then looking at that, that makes us overvalued, and again puts us at historically low numbers. Let's see, 25% currently, and again, let's look at what that means for these high and low ends. 46% on the low end. We know that that's possible. And 28% on the high end. We know that's possible. And that undervalues us. So I'm going to say this. I'm going to say, let me make sure I change this. Okay. I'm going to say that currently international paper is slightly overvalued. Yeah, slightly overvalued. And I'm saying that based on the low end numbers. So we're talking about 32 versus 40. Okay. And so, of course, the high end is where we can go. And so, what we can say here is that there is a range that IP is possibly looking at. And I really wish I had some historical data on whether or not the company tends to follow its book value or whether it follows its earnings. And just based on the company and the industry that it's in, I know for sure it follows the earnings, not necessarily the book value. I think that 2022 is not going to be as great as 2021. I think we've said that, right? And so the high of 53 sounds about right. The low of 32 means that we have a lot lower to go. The problem with saying 32 is what the heck takes the company down another 20%? It's got to be supply chain right now. It's got to be the war, right? The problem with saying any of this stuff, and we've already looked at this, is that we know that the Russian company only brings in $300 million. What is $300 million to a $20 billion company? That's not a lot, you know. It's literally like 1%. But stuff like that gets talked about in the news, and then that can affect stock price. So what I'm willing to do here is say that international paper is within a range. Okay, it's not definitely overvalued, but it's definitely not undervalued either. Okay, I'm willing to say that. It is definitely in a range. I think it's important to, at this point, monitor, which really and yeah. So let's talk about this. In the past, doing these valuations, the thoughts were it was always undervalued, right? And so that is changing now, right? That is going from not undervalued, but um, again, it's hard to say fairly valued. So again, I'm saying in a range. It's in a range. Something to definitely monitor. It's definitely not undervalued for sure. Definitely not undervalued. Definitely in a range. And if the price, if the stock price um, gets down to the $40 level, then watch out below. And so what I think is important for us then is that we have to be willing and ready to say goodbye to this position if it does get down to that $40 level. If it gets lower than 40, then we have to assume that this thing can get as low as 30. You know, um, and like I said, the problem is that on the high end we do have this $50 mark. We do have a $60 mark. We do have historical $60 share prices. Again, what gets us there, I don't know. That's the thing. I don't know what gets us there. Um, you know, and we didn't talk about what happens if they somehow surprise everyone to the upside. I can't imagine what that even looks like. Um, we're talking about maybe, possibly, you know, even if there we go. Yeah, even if we do get that gross margin, down, 5%, which is possible, but I doubt it. Um, that gets us to fairly valued, right? Because 70, I don't think it's possible, right? I don't think it's possible. So yeah, that's my thing. It's in a range. Definitely not undervalued, not overvalued, for sure. Definitely something to watch. If it does continue to move down, we have to be okay with saying goodbye at whatever price we can sell it for.